Hello, am I audible? Is this better,
Yeah,
team?
Vatsal, you're audible.
Okay, perfect. Really sorry, everyone, for the delay. Um, we can start, correct?
Uh, we can, right? So one sec, I'll just make you the co-host.
So, if will the audience be able to ask questions to me?
Yes. So uh, we have a separate event platform through which the audience is joined in,
Okay,
and I mean, speakers are on Zoom. So I will be facilitating the Q&A part towards the end.
wonderful.
Yeah. So you can share the screen now, Vatsal.
All right. Presume you can see it, Aditya,
Yeah, I can.
and it's full screen now.
Yes.
Perfect.
All right.
Great. Then I'll
So
start. Yeah, go ahead, Aditya.
let me just formally welcome you. Thank you so much, first of all, taking out time. I know you are on a Bangalore visit on work, and it is wonderful to have you taking out time out of your busy schedule. So, audience, welcome back to today's segment on alternate investments innovation. uh, uh, idea we have a master class by Vatsal, which is coming up first, and then we have a showcase session on art as an investment option by Mr. Rishiraj Sethi. Uh, so, so I mean, for the information of Vatsal and even other the audience which is joining for the first time today, this entire initiative of investment products innovation showcase we've conceptualized as a 10-day long program where each day we are focusing on different asset class, and the idea was to showcase or bring together some of the best and most innovative work that is being done in investment products. So the first day we had sessions on AIFs and PMS. Yesterday it was on offshore investments. 2 days alternates, and there are various other asset classes that we're touching upon for the next few days. So today's session, personally to me, is very, very interesting. I mean, now this is a space that Vatsal is going to talk about, where a lot of action is happening in the world of startups, in the world of funding, in the world of new, very, very exciting platforms that are coming up or are expected to come over the next few years. So what we essentially this masterclass is going to cover is how the future is going to be looking like. And I think, like all good investment professionals, this is a topic which we're all interested in, because we're always looking at those to be unicorns, right? Or to be successful strategies that over the next few years can make us a lot of money. So Vatsal is here today to talk about investing in Web3 companies, what he's trying to take us through or help us with his talk is to learn about the basics of evaluating Web3 companies or startups. That includes infrastructure plays, DFI, GameFi, and other subsectors. Vatsal, to introduce him quickly, don't go by his looks. He's a very, very young chap, but doing some very, very interesting work, and is already a principal and CTO at 100x VC, and leads the Web3 investments in the firm. He has already led 40 plus investments so far. He's also a partner at Mehta Ventures Family Office Investments, where he has been part of 50 plus deals around the world. Vatsal has previously spoken at prestigious organizations, and he's a very active voice when it comes to 100x VC cohorts that they keep setting up for different startups. So, Vatsal, thank you so much for joining in, and we are really looking forward to this session. We have around 60 minutes for this. So if towards the end of your talk, if we have some time, we can take some quick Q&A. I'll come back to moderate it for you. As I said, audience is joined through a separate platform. We are live, and I'm sure everyone is looking forward to hear to you today. So over to you. And if you need me for anything, I'm very much here. Yeah.
Perfect. Thank you so much, Aditya. It's a pleasure being here in front of all of you today. And thanks to Aditya for hosting me and to the qualified team. Very excited to talk about this topic today because I'm very passionate evangelist of Web3 and all its related technologies. Um, just to kind of set some context, right? And before I do that, let me give a quick disclaimer. None of these is, like right out of my mind, or I'm not a visionary, neither is 100x visionaries, right? There's a bunch of notes online, there's a bunch of thought leaders out there who are creating this, and we've kind of learned from them to understand blockchain, tokens, Bitcoin, cryptocurrency, open source, etc., 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 and tried to kind of create a thesis, a more structured thesis, which can allow people to invest in Web3 startups. Obviously, much of this might look like fiction since it is like very early stage and it's just the beginning of this industry, but science fiction becomes reality very, very quickly in front of our eyes. And finally, please remember, nothing should be construed as investment advice, whether a particular company is good or not, and so on. With that, let me start with saying that luck. Our family, Mehta Ventures family office, has been investing in Web3 since almost 2015, 2016 now. Obviously, one part, a major part of our returns and successes have been due to luck, right? Being in the crypto industry at the right time, we've been blessed to, kind of see some of the best gains in the industry, right? Just to talk about kind of what we've seen as a family. Obviously, Block One is one of our portfolio companies, which gave us 6,500% ICO. And that's a photo of Sanjay, who's also partner at 100x VC and founder of the family office, with the founders of EOS in their New York launch event, right? So it's a really big, and in fact, they're now going public with their product bullish.com through a SPAC soon enough. So, what a bullish.com is basically, it's a DEX, right? It's a decentralized crypto exchange. So just to kind of set some context on, what innovative businesses you see. So a decentralized crypto exchange is basically, there's two kinds, right? There's one which offers just order book based matching, right? Just like our current stock exchanges work, right? But the difference being all the matching is done through software. All the order books are put on the blockchain. There's no brokers. There's nobody in between, right? It's just a decentralized, nobody owns it, an exchange, right? And similarly, then there's automated market makers where it's not even an order book based, for exchange, right? And we'll talk a little bit on that. But that kind of gives you an understanding of what are the innovations happening. And this is in fact at a scale of almost, it's a $10 billion company nearly. So, you can imagine the scale of work going on in cryptocurrencies, right? And this is another one of our lucky successes, which is CoinDCX. They became India's first crypto unicorn and ended up, raising 90 billion by B Capital. In fact, their Series B round happened from Block One, which was one of our investment. We facilitated that introduction, that whole transaction. So, in the crypto space, as and when you keep investing more, you start seeing synergies within the portfolio itself. So, let's start from the basics, right? What's Bitcoin? Bitcoin is basically an efficient way of transferring value over the internet, right? And there's no bank involved. If you have to today send money to somebody in California, you're probably going to have to go to a bank, make an RTGS here, go into a SWIFT transaction, maybe from Mumbai to Dubai, Dubai to London, London to New York, and New York to LA, right? It's going to be a very long transaction. Bitcoin is very simple, right? From your wallet to there's no banks. It's completely decentralized. Nobody comes in between. It's a very fair market, right? Nobody has more information than anybody else. Everybody has information about everything. What are the transactions going on? Who's transacting with whom? What's the value of those? anything and everything is out in the open public for anybody to see. So, no chance of, cheating or, front running, etc. And anybody can become a node on the Bitcoin network, right? You can become a contributor, become one of the cogs of the network and lead it to becoming more decentralized, right? So there's no hacking possible of Bitcoin. You can't lose money or lose your assets with Bitcoin is not secure, right? Bitcoin itself cannot be hacked. There's no double spend. Um, there's no though cheating. There's no stealing of money. Nothing, right? Every time, and you will see this in every single bull cycle that crypto has. It starts with Bitcoin's price rising, which leads to investors investing more, developers building more projects coming out, all their values rising. And then kind of leading to a new set of startup projects and ideas in the crypto world, right? Now Bitcoin is one of the cryptocurrencies. It's more than a technology. It's not just a chain, right? It's a very easy way. It's a way to reimagine money. You're basically refactoring the whole banking system, right? If the banking system has been built slowly, steadily in small parts and piled over each other, Bitcoin just simplifies everything in it and puts it in code, right? So it's a very new way of creating money, of banking, of transactions, of payments, right? And it also showed that item, like the value of an item is not connected to it being physical, right? An item can be digital, it can be unique, and it can still have value, right? And you can enforce that uniqueness on a particular item. You can ensure scarcity of that item and so on, right? Now, some key terminology before I kind of go into investing, and I'm sure there's a bunch of questions. I'll kind of cover them at the end. I want to run through this really quickly so that it can be more open-ended. So, blockchains are basically software protocols that allow multiple parties to operate under shared assumptions and data without trusting each other, right? It's a trustless ecosystem. So this data can be anything. Updates to these data are called as blocks, and then there is blocks that chain together cryptographically to allow an audit of prior transactions. What that means is basically a simple thing, right? Everybody has a copy of the ledger, right? You have a copy of what's going on. I have a copy of what's going on, and 10 other people and hundreds of other people, millions of other people have the same copy, right? Now, when somebody wants to add a new transaction saying, hey, Vatsal paid Aditya, they're going to write it into a block, and that block will be added at the bottom of the ledger, and all of us have to add it, right? And whenever a majority of us add it to the chain, that's when it's accepted as an actual transaction, right? So none of us can fool the system, because to fool the system, we have to convince more than 15% of nodes, which are all individual nodes, with are all independent nodes, that, hey, I have made a transaction which is, which actually you don't know about. It's very tough to do that. It's impossible to do that, nearly impossible. And it grows even tougher the more and more people that adopt a particular blockchain, right? So more people there are in the blockchain, it becomes even tougher to kind of, fake any transaction or anything. Consensus protocol is what allows people to build consensus on what is the transactions that happened and what are the transactions that didn't happen, right? So, for example, in terms of Bitcoin, you use longest chain and proof of work. Proof of people use or nodes use. It's basically you solve complex mathematical problems to prove that a transaction that you're trying to verify is actually verified by you. You've done the hard work, and then you try to put it to the network, and then the network comes to a consensus that this proof of work that you've shown and the transaction that you've shown is legitimate or not and should be added to the chain or not. And that consensus in terms of Bitcoin would be longest chain, right? Whichever chain at any point of blocks is the longest will be the single source of truth. A smart contract is something, is basically it's code that can create and transform arbitrary data or tokens on top of the blockchain to which it belongs, right? Basically, you can write a contract in code related to any token or any piece of data which is on chain. So for example, if you want to create a quick escrow mechanism for a bet, right? Saying, okay, I'm putting in 10, and based on the event, the result of an event, the money will come to me or you. You can put it in code through a smart contract, and it will make sure that whenever the event does happen, the right person gets the money automatically. You don't need a trusted third party to enforce the event. It does it on its own because it's all code, it's all on a computer. Um, and Oracle, in the context of smart contract platforms, it's a data source for reporting any information external to the chain, right? For example, a stock ticker or cricket scores. For example, again, given the previous example, let's say you're betting somebody whether India will win against West Indies or not, right? So you can connect it to an Oracle, a trusted, external source, which will keep checking ClickBuzz or ESPN Info for the latest scores. And once the score actually comes through and the result is announced, it will the smart contract will read the Oracle and execute that. Okay, India won, so Vatsal gets the money from Aditya. A stable coin is any cryptocurrency which maintains price parity with a particular asset in the real world, right? So, for example, USD or gold, right? So there's USDC, USDT. These are all stable coins which are pegged to US dollar, right? So one USDT will always be $1 and one USDC will always be $1. And generally there are multiple ways to peg. Some use physical assets. So USDC has an actual dollar bill for every dollar. Some use a slightly lesser constrained physical backing. So for USDT invests in bonds, etc., which are slightly more volatile than cash. So you don't actually know if it has the dollar value or not. And some try to do it algorithmically. So DAI, and in fact, you might have heard of the Terra Luna crash. So US Terra was a USD stablecoin. It was completely algorithmic. There was no physical backing. And that's where it was a very weak peg. So it broke down and led to a bank run, right? But comparatively, DAI is a mix of partially algorithmic, partially physically backed, and it's been strong since almost 2017, 18. So there's a various bunch of stablecoins, but the funda you have to remember is it's what allows people to have the ability to invest in crypto without worrying about volatility and participate in DeFi. We come to DeFi. Decentralized applications are basically a mix of multiple smart contracts that create a whole larger product that can be used, right? A DAO is a decentralized autonomous organization, which is basically a structure of a company or any way to organize a bunch of people in code. So all relationships are written in code, all payments are written in code, all incentives are written in code. Who has what voting rights, who doesn't have what voting rights. There are governance tokens, which allows people to participate in governance and who gets how many, etc. Which governance tokens, correspond to which rights. Everything is written in code. So you don't need, any HR or compliance or CS or anybody, right? Everything's written in code. The organization structure is defined, and people behave according to the rules of the organization. Atomicity is a very critical feature of transactions in blockchain, and I'll come to why. Basically, if you're moving money through multiple contracts, a DApp or something, one transaction, it can be considered as one transaction, right? So let's say you're trying to move money from your wallet to a market maker, buy some other token and send it into another liquidity pool. If you make this an atomic transaction, if at any point one part of the transaction fails, the whole transaction fails, and hence you get money back, right? So it's not like you will lose money if one transaction works and the other doesn't. Then you're not going to lose money, right? You're either the whole multiple steps go through or none of them go through, right? And finally, composability is very critical, and I'll talk about why. But basically, it means that multiple dApps and DAOs can effectively always connect with each other and build on top of each other and create synergies in very easy manner. Basically, all these products, all these dApps are built in an open API manner, right? Anybody can connect, any product can connect into it very easily. So, just kind of to talk a little bit on how Web3 waves come, right? So you first see a bunch of apps coming. It's counterintuitive because we think about, okay, the infra has to be built first and then the apps will come. It's actually the other way, where the apps come and scale beyond, the potential of the infra. Then the infra scales to match the demand of the app, and that leads to another wave of innovation, which pushes the app, kind of the pushes the infra capabilities, and again you upgrade the infra and so on and so forth, right? So it's very similar to how light bulbs were invented before the electric grid but couldn't scale without it, right? So similarly, any product has to be built first and then the infra goes to match the demand, right? So this is broadly how it looks like. So in 2008 you had BTC as the killer app, first killer app, then infra built around it, the Bitcoin blockchain network, the Coinbase for exchange, Ethereum, ERC20, MetaMask, etc. On top of which people built apps to even push beyond. Silk Road was one of the first marketplaces to be built on top of Ethereum and Bitcoin. You had a bunch of ICOs, tokens, Roulette, VDICE, CryptoKitties, Augur, which led to other infra work, right? Side chains, Blockstack, rollups, Web3 APIs, ERC 721, which defines NFTs. And that led to another, while here it says to be seen, our most recent wave was an app wave, right? Which was along the lines of further work on NFTs, GameFi, DeFi, etc., etc., etc. So, that's kind of how the innovation cycle happens. And currently, we're at the peak of the app cycle. So we're expecting to see a lot more infra work happening over the next few years. Just something that is generally well known in the ecosystem is the FAT protocol thesis. Whereas generally in Web 2, right, in our world, the regular internet world, all the value is accrued at the application layer, right? It's at Zoom, it's at Google Meet, it's at Gmail. That's where the main money is, right? The protocol itself, internet or HTTP or www or TCP/IP, those don't make money. They're generally free, open for anybody to use. The internet layer as well doesn't make any money, right? Telecom doesn't make as much money as these applications built on the internet do, right? On the blockchain, it's supposed to be the other way around, right? Protocols accrue most of the value, right? Being part of Ethereum or any other protocol is where the money is, right? Applications are very fungible. There's very little moat to them. It's very tough to create value at the application layer. And so most of the value or the wealth in cryptocurrencies is created and tied up in the protocol layer, right? Now there's also a shared data layer, which allows all the data of users to be held in a central place, right? On chain, right, on the blockchain, and to be shared equally among their applications built on top. Historically, if you think about it, Google had access to its own data, Apple has its own data, everybody has its own data, and they try to keep it siloed and prevent others from accessing it. But what happens with Bitcoin and blockchain in general is that everybody has access to all the data, right? Transaction, user behavior, etc., 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 right? You can't, data is no longer a moat, and nor is it a barrier of entry, right? So your right to win goes a lot beyond the data. The FAT application thesis is kind of a counter to the FAT protocol thesis, where the idea is going ahead, right? There will be opportunities to, invest in great products on the application side, because these applications will not live on one chain, right? If you're investing in great applications, they have to be multi-chain and cross-chain, which means they support Bitcoin, they support Ethereum, they also support Solana and any other chain by default. And for users, they'll have to kind of abstract this chain layer and make sure users don't know and don't what protocol or the application works on. You just got to make it kind of very easy for users to do their job, whatever they've come on the application to do. As an example, Aave is one of those, which is like multi-chain, and SUS cross-chain, right? So just to define, multi-chain is supporting multiple chains, and cross-chain means supporting transactions on one chain from one chain to the other, right? So I want to make kind of a big statement right here. Crypto brings the imagination and flexibility of finance to a fully functioning decentralized computer. You have to think about the blockchain ecosystem, Bitcoin or Ethereum, the whole network as one large decentralized supercomputer, right? So because it's a computer, you can code anything on top of it that you can on a computer. And as you may know, finance is only limited by your imagination. So the more you can imagine with the flexibility of finance, the more you can build on top of the computer, right? Anything you can imagine, you can build on top, right? So that means the opportunity is so huge because there's just so many things you can build. You're only limited by your imagination. Like I said, anything you can imagine can be built on Web3. Another important point to note is all code in crypto is open source, right? Crypto is not trustless. There is trust, but the trust moves from people to code, right? Because you can read the code, you can see the code, you can explore the code. If you don't like something, you can make changes to it, or if you don't like it, you just create a new project, right? You can copy the code, paste it, and create a new project, right? And people vote with their feet. Right? So if you trust a particular project after seeing their code, then you're gonna use that project. And similarly, if multiple people trust that, that code base, that project, then they're gonna vote with their feet and give that project value, right? Now, some basic diligence you can perform common to Web3 projects, right? First, obviously, is the value of valuation of a project. Just because it can be done, do people really want to do it, right? This is just like any other business, right? Like I said earlier, you're only limited by your imagination. You can build anything you can imagine, but that doesn't mean you should build everything you can imagine. So it's critical to ask if does this really need to be built? Do people really want it, right? Is there actual decentralization on top of this, right? Or can it only be built on the blockchain? Like I mean, many of you, if you've heard of startup pitches, or at least we do, almost 1 in 10 tends to add that Web3 keyword just to create hype. Right? They think, oh, people will hear Web3 or blockchain and metaverse and something, and they'll think, oh, yeah, this is fundable. But just because, again, you can add Web3 to it doesn't mean it needs Web3, right? It has to be something which is uniquely supported by the blockchain ecosystem. Team is going to be a very, very critical role. So team story, experience, and integrity is something you're going to look out for. Do they know what they're doing, how to do it, and are they doing it out of a mission? And we'll cover this again in depth a bit later. Community development, evangelism, are they kind of working to build community? Since the code is open source, it can be copied in seconds. The only moat is the community, the trust, and network effects that you are able to build. The business plan, the tokenomics of the business, and finally, some sort of smart contract auditing, right, which is generally done by third-party services subject to the stage of the company. So this is where third-party companies kind of go through the entire code base of a certain project and give it a thumbs up saying, hey, we've checked it out. There are no security flaws here, at least not that we know of, right? Now, on the value proposition side of things, you want to ask the general questions, right? What kind of market is this project going to challenge? What kind of problems does it solve? How does it compare with incumbents and competitors? What kind of economic benefits it has entailed? And how does it relate to other blockchain technologies? Let me give an anti-example of something which does not have a value proposition, right? So you might have heard of a couple of companies doing, okay, yeah, we're going to put the entire supply chain of a particular product on chain, right? So nobody can lie about where this product came from. So from farm to fork, if you've had this, bangan, you can scan a QR code and see कि ये बैंगन कहाँ से आया. कलकत्ता में it was grown in Calcutta and then shipped to shipped to Delhi, and then Delhi se Bombay, and then Bombay to your plate, right? Now, what's the market this going to challenge, right? This is challenging there doesn't exist a market for this, right? But does it solve a problem? Well, in this case, I would say it doesn't, right? Because people don't really want to know, and companies don't want to share this kind of data. Right? So this is not a real problem that exists. You don't keep asking for every single vegetable, ye bangan aaya kahan se? Right? So it doesn't make sense. Does it have economic benefits? No, it increases costs, in fact, right? It it doesn't reduce costs for either you as a consumer or for anybody in the supply chain. Does it relate to other blockchain technologies? Absolutely not, right? It adds nothing to the entire blockchain ecosystem, right? So just to kind of set that as an example, right? You have to make sure this is something that really has value for the and can create value through the blockchain ecosystem. And similarly, on that example, right? Is this project uniquely enabled by blockchain technology? No, you can put it on a regular database, right? Does this solution absolutely need to be decentralized? Absolutely not. You can still put it on a centralized database, and it's going to be very costly for people to execute these transactions for every single movement that happens for that particular for that Bengal, right? You're going to have to pay 10 rupees, 20 rupees to write that transaction on the blockchain. That doesn't make sense, right? I mean, it's just too costly. So you have to remember that the blockchain network and its community relies on the business model of the contributors, who are the miners, the developers, the stakeholders, and the decentralized technologies, right? Now, if the project is not completely enabled or dependent on being a blockchain first project, then there's not enough value for any of these contributors to come. And if there's not enough value for any of these contributors to come, it's going to fail, right? Now, on the team side, you want to look at a bunch of things. The first being their experience and success stories. Obviously, some team members will have experience and success stories in the context of the project, right? As an example, somebody who's building Web3 based social media, but has previously built and scaled an actual Web2 based social media and then sold it off to Facebook would be better, targeted to move that into Web3 as well. That is one way. Or alternatively, for example, BlockFund, right? Dan Larimer, who was the CTO of BlockFund back then, had built and scaled and sold multiple, blockchain projects by then already, right? So, and launched multiple ICOs. So, you knew that founder had some experience in really building the business out. Integrity is going to be very critical, here because, founders can in the Web3 ecosystem, it is very easy for founders to take the money and just say, hey, the project failed, it didn't work, right? As compared to that, generally many fundraisers happen through tokens, not even through equity, or not even in the jurisdiction of your country, right? They might be incorporated in BVI, somewhere in Caymans, or they're doing a token sale, which doesn't give you any equity or any rights onto the company, right? So it becomes very tough for you to chase these companies if they're not integrated, if they don't have integrity. So you have to make sure they have no questionable background, position for conflict of interest that will compromise their work. The network, it's very important to so network and missions, let me take it together, right? Basic idea is the team should be really passionate about what they're building, and really passionate about the Web3 ecosystem itself. And B, they should be surrounded by other people who are of that kind, right? Those two are very positive signs that this team gets it, right? Because when they're around other people doing in the same space, right? That they're really interested. They're making this their life, right? They're eating, sleeping, breathing only Web3 crypto, right? And on the other hand, if they're in it for a mission, right? Then they're not doing this because this is the money, this is where the money or the hype is, right? They're not mercenaries. They're not looking for a quick exit, right? They're here for the long term. They want to see this project through, raise it, build a $1 billion, multi-billion-dollar project out of this. So one really quick, heuristic to see if a team is the right one or not. The above is the GitHub contributions of an actual blockchain CTO. And the below is of somebody who's just posing as a blockchain CTO, right? So the green color basically says they're making daily code contributions, coding on a daily basis, just shipping a lot, right? Just writing code and shipping it on a daily basis. Whereas the below is like, okay, there are a few days they've written code, but nothing else, right? So there's a great heuristic to kind of measure if that individual, the CTO who claims that they know what they're doing, is actually contributing to crypto or not, right? Community development interaction, the size and the activity of a community is very, very essential for the adoption and health of a blockchain project. The size and effort committed by a community will allow you to measure the level of adoption this project may have, the level of maturity this project has already, and the speed at which the project is evolving, right? So because like I said earlier, right, there's no moat in this business apart from the community that you can build around it and the network effects. If you lose the trust of the community, your project goes to zero. That's exactly what happened with the Terra Luna ecosystem way back in April, I guess. Right? And it's because people lost trust. And so it became a bank run and everything went to zero quickly. Right? It's very critical to build a great community, gain their trust and maintain their trust, right? And the rate at which the community increases, adopts, and has conversations, has mature conversations, is a great sign of the health of the project. So you may want to check out the Discord, the Telegram, the GitHub repositories for external commits, which give a good sign and a good heuristic of how active the community is. I'm just going to take a break here for a sip of coffee. Sorry. So yeah, continuing from there. So on the business plan side of things, right? You have to look at the financial plan. Obviously, what is the effectiveness of the project? Is its presence going to be useful, not useful? If the presence is not very useful and it's not leading to the outcomes expected, then that's kind of not a good thing, right? So you gotta kind of study that, okay, what's their plan of how fast is this supposed to grow, how fast are the tokens supposed to grow, how fast are the adoption supposed to grow, what kind of people will adopt, etc., etc., etc. Standard business plan. What's the market size of this, the potential market reachable by the product? Usually for blockchain projects, we think globally, right? Your market is never limited by geography. And then finally, the token model, when applicable, which describes the main parameters of the tokens issued by the project, the quantity, modality of issue, distribution rights. Basically, on the token front, we want to look at, do they really need tokens? How are they going to send tokens? How are they going to price it? How do they set the incentive mechanism, the tokenomics? And we'll come to that soon. And what are the rights people get? So now, tokenomics, right? Now, you have to remember that the token economics design is very critical to any project, right? Because it's the token speculation, right? People believe that the token will increase in value, hence they contribute to the project, they buy more of it. And the more they build and contribute on top of it, the more they create value, the more the community gets engaged, and hence the value increases and so on and so forth, right? So creating the right incentive cycle, a virtuous incentive cycle, will make sure that the price of the token actually increases and there's real value creation in the ecosystem of a particular blockchain, right? Now, the goal of any tokenomics through its incentives policies should be to ensure the protocol's growth, sustainability, and safety. It should take priority for the individual stakeholder objectives. So the priority should be to grow the project, to get people to develop on it, to get people to use it, not ever to create wealth for founders or for investors or for early holders, right? But yes, ideally then over time, as the product grows, the tokenomics will ensure that everybody gets a chunk of wealth, right? It is critical, few things to look is critical to understand how they propose creation, burning of the tokens. Burning is destruction of the tokens, right? And how they propose limiting or growing the supply, right? So every project will have a different requirement. Some projects like Bitcoin are supposed to be limited in supply. There's only ever going to be 21 million Bitcoin, right? And it's created only by mining that coin, right? By doing proof of work. Now, it's very, very simply written and very clearly stated how that works, right? So every project has a different need. Some projects need an inflationary supply. Some projects need the ability to create, but also burn tokens, right? So depending on the need, it's important to understand how they propose to do that. It's important to understand the incentives they're giving to stakeholders, to the miners, to the developers, to the moderators, to the stakers, etc., who are creating value by contributing to the ecosystem consistently, by contributing to the protocol consistently. You have to understand the fees they want to charge users who are deriving value, right? This is one of the biggest criticism, if you've heard recently, that Meta got, right? When they wanted to launch their metaverse platform, they want to take a 40% fee of any transaction that's happening on the metaverse, and that really does not make sense, right? Because everybody else is creating a majority of the value, and then Facebook just want to go ahead and take 40% of that, right? Which is not ideal. So you have to find the right balance, which creates enough value for the company, which creates enough value for the ecosystem, because some of that value will go back to the rest of the stakeholders who are managing the ecosystem, and enough for the users, right? And it's important to understand how the parent company earns from the protocol. Sometimes parent company only launch the protocol, they hold certain supply of tokens, but that's it, they own that. Some want to keep building on top of the token, and they get the stakeholder incentives itself, right? So how will the parent company post the launch of the protocol really make money from it is important, right? Because your investment is in the parent company in the end. On the red flags front, you want to look at the vesting period of tokens for founders. If they're looking at, quick vesting, as soon as it's launched within 3 months, it's completely vested or something like that, then they're probably looking to pump and dump, right? Just raise the price and dump it out, which is not ideal. You want them to stay longer into the project, right? And the number of tokens they're keeping for active participants of the community. So almost 40, 50, actually more than 50 to 60% of the entire token supply should be engaged in incentivizing stakeholders, active participants, etc., in any single way, right? Now, there's also something called governance tokens, which are separate from the regular tokens of the project. These many of these applications of protocols like Uniswap or Aave or etc. will have DAOs to govern the rules of the protocol, right? So let's say Aave is a lending protocol, just like you have the RBI to set interest rates for the Indian economy and banks in India. Similarly, this DAO will decide, okay, what should the lending rates be on Aave, what should be the collateralization ratio, etc., right? So there are users who have governance tokens, which they use to kind of vote and govern this protocol, right, and make decisions for it. These governance tokens will also have its economics and consensus mechanisms. There's a lot to study. I'm not going to do that, but you create incentives for people to keep govern more, maybe give them a share of the profits or something along those lines. Right? There is no right answer to governance. There's a lot of research happening on that front, and we're still learning. It's very early days to figure out how to structure. Do a sector-wise breakdown now. I know it's 3:45. I'll try to run through this in like 5-7 minutes, and then we'll close. So there's L1, L2 protocols. These are the kind of businesses you will see which accrue the most value. So Ethereum, Bitcoin, Solana, these are examples of level 1 protocols, right? Which are standalone projects, blockchains on which they expect other people to build this, right? So these compete with Ethereum and Bitcoin. And L2 protocols are built on top of this L1, like Ethereum, Bitcoin, or Solana, or AVAX, Avalanche, or any other, right? And so the idea is with each of these, right, you're basically trying to create an entire blockchain on top of a blockchain. And for that, you need a very, very technical team of founders who have knowledge of systems programming, of distributed systems. They have to be like very knowledgeable founders, right? In computer science, right? It's a very tough problem to solve, very difficult products to build. You have to read through the white paper. All these projects release a white paper which defines how the project is expected to work, and ensure that you've thoroughly read and researched that white paper, and that. And once the product has been built, what will be important is how they're creating a great ICO or airdrop which prevents concentration of token, right? So that GTM is going to be critical, because this ICO, this airdrop, is also the incentive for a community to be engaged in the project, right? So how do you give enough tokens to a varied set of people who also start using those tokens immediately once the project is launched is going to be an interesting problem to solve. So that GTM is very critical, right? Just as an example, Block1 had a 1-year-long ICO where every day they were, allowing people to buy into a certain amount of tokens. And that's how they had a $4.5 billion ICO. There are other infra companies, wallets, bridges, rollups, etc. Most of these tend to be very fungible, right? What that means is one wallet you use, the other wallet you use, swap it. It's easy for people to move, right? There's very little lock-in. So it's important to understand, while these are great businesses, so you have to understand how will they build the moat, right? Are there network effects to this product? How will they make money? These are problems that largely stay etc. Then there's decentralized finance. This is where the fun really starts, right? So decentralized finance is everything you're doing in regular finance, but on the blockchain. Lending, you can do it on the blockchain. Market making, that is, exchanges, you can do it on the blockchain. There's a project called Synthetics, for example, which allows you to create derivatives out of real world assets as well, and kind of bet on the price action of this assets. There's NFT fractionalization. One of our portfolio companies, Strive, allows you to fractionalize NFTs and then sell those fractional version of those NFTs online. So there are so many different things happening in the decentralized finance world. It's crazy, right? So in this case, most of the liquidity to bootstrap these decentralized finance, right? Let's say there's an example of an automated market maker, right? Uniswap is an automated market maker. What's an automated market maker? It's where basically they have a liquidity pool that is a collection, a wallet which has a collection of tokens, right? So you'll have 100 Ethereum, 100 Bitcoin, 100 Solana, everything. I don't have to, like in general order book based exchanges, right? You're going to have to wait for somebody to put in a sell order and then get matched with them. In this case, you're not waiting for anybody to sell. There's an available pool of liquidity from which you can directly buy. And there's a price setting mechanism, right? So you have to look at their ability to create those liquidity pools, bring in multiple people to kind of contribute their liquidity to a particular project, but also create the algorithms which lead to this price making or the incentives, the fee structure, etc. Composability is going to be a very critical part of decentralized, right? Like we talked earlier, composability is the ability to build on top of one another. So imagine you have a lending product, right? Like an Aave or something. Let's say you build a game and then add lending as a feature of that game by adding Aave on top of it. So you were able to build a whole lending feature into your game using Aave, which is an existing product or a existing dApp on the chain, right? So in this ways, if you're able to match multiple things together, right, multiple DeFi protocols over each other, it creates a lot more value. So if somebody's building a decentralized finance product, they have to do it with a composability in mind, right? And in fact, it is because of composability that these DeFi products, which could ideally initially have been an application, suddenly become protocols because people start building on top of the DeFi applications. One thing to remember about DeFi is arbitrage is a feature, right? So lots of DeFi products leverage arbitrage to, for example, AMMs themselves leverage arbitrage to keep price parity with other markets and avoid slippage, right? Kind of thing. So it's important to understand how these projects are thinking of arbitrage and how they're leveraging this and other behavioral features to create more value for us. Then there's GameFi. GameFi is basically games, metaverse, plus DeFi, right? Decentralized finance. So you basically can have a game. Let's say you guys play Candy Crush. I presume some of you might. You get those tokens or those things, right? The candies and extra gifts that you get, which allow you to win the game. Right now, imagine putting all those tokens that you're getting by playing games on Candy Crush and all more on the chain. What would you be able to do with that? You could sell all the extra tokens you've earned to somebody else who wants them. You could move those tokens to another game. Let's say you're also playing Farmville. You can exchange them for Farmville tokens and in fact use those to make money on Farmville, and so on and so forth. You can lend people those tokens and they can pay it back to you with interest. So GameFi is basically games built on top of DeFi, and it allows for a whole new set of applications. So in that case, what is most important is the ability to build game dynamics and storyline. Presumably, they'll be using DeFi protocols which already exist and building on top of it through composability. So you want to make sure that they can actually build the game, right? So game dynamics, storyline, designing the game economics, not too many tokens, not too less tokens, etc. Is it an open world, right? Does it allow for people to build on top of this world and extend it? And like I said, is it composable, right? Build on top of it and match it with other games. Now, there's actually a very interesting evolution that has happened in this space. It's called in-game physics on chain, right? So developers have been able to put, like, you know how in a real world the speed of light is only 300,000 meters per second, right? That's a rule that is embedded across the universe. So similarly, developers have been able to create blockchains with physics rules embedded on chain. So any games built on those chains will have to follow the same physics, which means assets in one game will have well-defined behavior in another game, and hence they'll be able to be moved around a lot better. So lots of interesting stuff happening here, but this is broadly what you'll be looking at to evaluate the space. Yeah, but that's broadly what I wanted to cover. Really sorry it went on longer than expected, but I'm happy to answer any questions. I hope it didn't get too technical.
Hello. Yeah.
Yeah, yeah.
Yeah, Vatsal, hi. I was listening to you intently for like almost half an hour and got a call and I had to kind of conk off. I would love to first go through the recording at first instance now because this is very fascinating. I mean, especially for the non-tech guys like us, listening to this entire world of Web3, I thought we need more time with you for future such sessions. So
Absolutely.
So audience, if you have any questions, quickly share because we're almost out of time. If not, you can always reach out to Vatsal on the contact details. I'm sure what he very subtly covered and very smoothly covered in our for a lot of us, this will need much more time to kind of chew on this and kind of understand it better. So if you want to reach out to Vatsal later, you can do that here. If you have any questions right now, please quickly ask. We have another couple of minutes to go. So Vatsal, just hold on. I'll quickly check if there are any questions. So audience, you have a question button, manage option button on the left side of the footer of the screen. And through that, you can find ask a question tab. So if you have any questions, please quickly put in. Okay, I just have a request, Vatsal, from one of the members here. Can you, suggest some blogs or some publications or even blogs that can help the audience understand about the entire space better?
Yeah, actually, there's a very good YouTube channel. Let me just search it and put it on chat. And it's very helpful. There's a lot of stuff in this place. So it's a bit, I can understand it can be a bit overwhelming. Let me just, I'll share that with you, Aditya. I can't find it right now. I'll share it with you.
Sure. Please do that, and audience will be happy to share it with all of you. I'm sure this deserves a standalone session and a more in-person session for a topic like this. So I'm sure I'm hoping whenever he's back, we should have something here in Mumbai at least. Vatsal, I mean, I'm just while I'm waiting for audience questions, I'd also like to know your views on. So there's a lot of uncertainty around Bitcoins and this asset class. I mean, uh, honestly, it is very difficult to make out the correct news from the wrong news and or the rumors. So just a quick take on. I mean, what do you think is the future for cryptos and where are we leading to, kind of? I mean, and how like a general investor can make use of an opportunity like this?
Yeah. So good question. I think it's see, the way to think about this is, it's not gonna be that crypto is gonna replace um, you know replace the rupee or anything like that. That's not at least for the next 50 odd years. That's not what's gonna happen. Kind of things. But what's gonna happen is how this is gonna evolve is, the digital economy is gonna separate from the physical economy, right? So you're gonna start kind of providing your services online. You'll earn in Bitcoin, but you'll never convert that back to fiat. You'll just use that to buy other services or product online. And this is maybe a 10-15 year down journey with the advance in GameFi, with the advance in on-chain gaming, etc., etc. So that's kind of how it's going to start. It's slowly but steadily. You will have a separate um, uh, life online where you have a separate set of economic activities you're doing online, set of products consuming online, and that would be different from what you're doing already offline. And then maybe 50 odd years down, you'll see them kind of converging, kind of thing. So um, yeah, that's how it's gonna evolve. From an investor perspective, the way to get involved in this space is only to really start studying. Man. There's just so much. See, a lot of people want to invest in crypto, but you have to educate yourself before you do. Become part of communities, learn about projects, contribute. There's a lot that non-technical people can contribute to. The more you contribute, the more you read, the more you learn, the more you get excited, the more you'll be able to be a part of the future. So that's kind of how I see this evolving into the future and how kind of investors should think about participating. Right? Um,
Great. So there's one question, and I'll take it as the last one here because we're out of time now. So are there any efforts being made on at 100x or on behalf of the industry to bring this entire asset class under regulations?
yes, there's a fair bit of work going on in the industry, not 100x per se. A fair bit of work going on in the industry to kind of bring more regulation and bring more structure to the asset class into the space so that people can invest with more ease of mind. And I think the forerunners in that space tend to be countries like New Zealand. New Zealand has a really strong 3, 4, 5 year plan in order to kind of allow their retail investors to really slowly understand, slowly participate, and over time grow their engagement in the crypto ecosystem, right? So I think that's a very well structured policy they have. So it's going to happen. It's happening slowly, steadily, and we won't even notice it until the world changes all of a sudden.
Sure. Great. What's up? So can't thank you enough for this very, very special masterclass you conducted for us. Look forward to having more such sessions from you. hopefully in person now. We would love to take more questions, but we're just out of time. I think our next speaker is already here. So thanks again, Vatsal, and have a great day and great trip. And I see you back in one of our events.
Absolutely. Thanks, Aditya. Thanks, the Qualify team.
Bye. So audience, quickly moving on to the second and the last session of the day. We have with us Mr. Rishi Raj Sethi. Rishi, if you're here, I'll request you to please put on your video. Hello, Rishi.
Aditya, can you hear me?
Yeah, I can hear you.
Yes. I'm sorry. I'm slightly no network in Delhi, so there will be some lag. Let's hope it doesn't break in between. That's all.
Okay, so yeah, I can see you also now.
Can
Hi.
I just try the slides and see if there's not too much lag? Just one second.
Sure. I made you the co-host. You can share your screen now.
Sure.
So audience, Rishi is a very, very well-known name in the art circles, and he runs, he's the founder of Aura Art. He's a CA and CFA by qualification, who worked with some of the large consulting firms before he founded Aura Art, and now complete a passionate crusader for the art investment industry in India. I've had the privilege of engaging with him on similar such initiatives in the past, and I thought when we're talking about alternate investment innovation segment, a session on art by Rishi is definitely a must for the audience. So thank you, Rishi, for joining in, and we look forward to your session now. So our audience is joining as you know, through a separate virtual platform, and I'll be there to facilitate if there are any Q&A towards the end. We have another 20 odd minutes, 25 minutes for this session.
Sure. Is the
Over to you.
slide visible? Is it changing as well?
I'm sorry, come again?
Are you able to see the slide changes?
Yeah, I'm able to see the slide change.
Wonderful. Wonderful. Great. Great. I'll take it off from here then. Thanks a lot, Aditya, for having me here. It's always a pleasure. For our friends who are joining, possibly hearing something like this, just increase the volume. Art, as we know, friends, has always been understood for it's one of its primary objectives, which is to add aesthetic beauty to an environment, to decorate a wall, to add life to a home, to an office, to a hospital, to a hotel. What we are trying to also understand and step back here is see that how art is also a significant wealth creation tool. And it has been the case for a couple of centuries in the West. We have very significant examples of deep-rooted collections being built over, maintained, added to, and then divested, which I think is a phenomenal amount of validation to this as a asset class in the West. And as wealth percolates beyond a particular point in the economy, we will see how China took the benefit of increasing share in wealth of art, and now India is tipped to be in that inflection point as we speak. Taking some very headline Yes, is it clear now? I'm sorry. I was worried about this. Are the slides visible now? Is the slide visible? Is the slide visible now? Can you hear me?
Yeah, I can hear you.
Is the slide visible?
No, no.
Is it visible now?
Your screen is visible now.
Not the slide. Okay.
Yes, now the slide, yeah.
Is it visible now, the slide? Hello?
No, it's not, Rishi. Now it is, yeah.
It is? Yeah.
Yeah.
So I'll continue then. Yes. So nurturing, as I gave an example, the Rushfield family has been allocating 1/3 of its wealth to art for the last 150 years, which you can imagine is a very, very long period to have a significant allocation. Likewise, we have a rail pension fund in Britain, and you can imagine pension funds are the most conservative in asset allocation, actually allocate capital towards art for a long period of time with positive results, beating the market. The World Wealth Report, which is an important Bible for wealth creation globally, has been advocating passive investments as a very important new trend in collection. The bottom left graph is very interesting. As we discussed China, let's take other Asian economies first. Uh, Japan actually has sort of reached a situation where art and other such luxuries are a way of life. India, on the other extreme, is moving from a saving culture, a subjugation culture, to what we call the start of money. And China has moved one step ahead to a show off point, which is when the focus on art and collectibles increases very significantly. And as India now reaches that threshold, we will see what happened to China, which will happen to India now. Again, very interesting, this data point. Treasure map, 17% of Chinese ultra wealth is already in treasures, with art being the number one treasure, whereas only 3% of the ultra wealth is in treasures right now. And this is precious diamonds, jewelry, hides that, and art is not in the first top three. This slide is interesting. Again, it shows that how with jewelry typically or with gold and diamonds, there has been a preponderance of a reduced interest in adding to that asset class after a particular amount of exposure. Is it visible now?
No, it's not visible.
Now is it there?
No, Rishi, it's not visible. I believe
Gosh,
I believe
I
if
really
it looks like a really bad network. Maybe we can reschedule this session once you're back.
I think that'll be simpler. Yes, it's not really good.
Because your voice is also breaking a lot.
Let me know any other day.
Sure. So
Yeah, I think that's a good idea. If you should reschedule, I'm back tonight. Any other day is fine.
yeah. So audience, I think we'll just reschedule the session because Rishi's, as you all can see, is struggling with the network connectivity. We'll try to do this within this before 12th. Thanks, Rishi, for joining in, and
Thank-
look forward to redo
Yeah.
this session. Yeah. Okay. Thank you.